if something happens to me, how is my family going to make sure that they can still earn the same $10,000 and maintain the same lifestyle? Be honest. Ha, that is funny. Have you ever sold insurance to a family member just to hit your monthly target? Hello, my name is Harpreet Singh. I'm the founder at Zoho Financial, and I'm the financial advisor who predominantly works with real estate, healthcare, and IT professionals and business owners. And as recently as last week, I just got the Top Financial Advisor Platinum Award in Ottawa, and Zoho Financial won the Top Financial Advisory Firm in Ottawa. And today I'm here to answer a few questions for you from the Truth Box. Okay. Is mortgage insurance mandatory from the bank when I take a home loan? So the short answer, no. Mortgage insurance is not mandatory when you take a home loan, as much as sometimes your lenders, they can make you feel like it, but it's not mandatory. However, my opinion will always be that if you are buying a home, then make sure that you get your insurance needs assessed by a professional, and make sure that you are adequately covered for not just your loans and liabilities, but also for your lifestyle. And don't do mortgage insurance though. Buy your own personal life insurance always. Okay. What is the real difference between mortgage default insurance and term life insurance? So, very two different things actually, because the term life insurance is a set term. So, as an example, if you are a 30-year-old and you buy a term 30 life insurance, that just means that if something happens to your life in the next 30 years, your family or your beneficiaries will get a certain amount of money paid. On the other hand, the mortgage default insurance would be that if I do not pay my mortgage and my lender is now going to be not paid by me, and they will actually get paid by an insurance company who has insured the lender. So mortgage default really only takes care of your lender. So, for example, CMHC is the biggest mortgage default insurer in Canada, and they will just make sure that your lender, for example, the big bank who has given you the loan, they get paid if you do not pay that. So, how much term life insurance do Canadians typically need? Now, that's a very broad question, I would say. There is no one formula to do it, but I would say some people just go by how much do I owe, how much loans do I have. I personally am a bigger fan of the idea of a lifestyle maintenance. So, as an example, if you and your family are living a comfortable lifestyle and you guys spend $10,000 a month for maintaining a certain lifestyle, that includes your kids' activities, that includes your cars, that includes your house, that includes all sorts of travel and whatnot. So the idea should be that if something happens to me, how is my family going to make sure that they can still earn the same $10,000 and maintain the same lifestyle? So that would be the criteria to buy the life insurance. So if it means that I need to have $1 million life term insurance for maintaining that lifestyle, then be it. The next question, this truth box is taking a lot of truth out. Is term insurance a waste of money if I don't die during the term? Fun question. Is term insurance a waste of money? It's as much a waste of money as your car insurance is. It's as much waste of money as your home insurance is, because they also don't give you any money. And I'm pretty sure that none of us is sitting there and praying that, oh, my house should catch fire so that my insurance can pay me, or my car should be bumping into another car so that my insurance can pay me. And the same thing that goes here. So this is one game of gambling or roulette where you actually want to lose. So It is there to protect your family. It is there to protect your lifestyle. It is there to protect your loved ones. But we all hope that it never actually pays out and the money does go to waste, if that's what you call it. Do I lose all my RESP money if my child does not go to college or university? So RESP, that stands for Registered Educational Savings Plan, which you normally set up for your child or children who may go to university at some point. So it depends on what type of RESP do you open. So if you open your RESP with a typical bank, or if you open it with a qualified financial advisor, my hope is that none of them is going to be a plan where you risk losing money. But if you invest in those plans that are typically called group or pooled plans, in those, there are some risks where if the child does not go to university, the money that's left over is actually going back into the pool and it gets divided amongst all the members of the pool or the members of the group. So if out of 10,000 people in the pool, let's say 100 kids do not go to university, the money gets divided over to the rest 9,900 people. And if you happen to be, unfortunately, one of those 100, then you do risk losing money. And that's why I'm personally not a very big fan of those group or pooled RESP plans, because I say it should be your individual or your own family plan that you control.
So in the individual plan, you get your money back?
So in the individual plan, there are ways that you get your money back. That if the child does not go to university, the grant money that the government has given you has to be given back to the government. There can be some penalty depending on that as well, that how much the money has grown. And the rest of the money, which we are talking about, which is your principal, 100% of that principal comes back to you, and you pay no tax on that money because it is a principal. Then there is the growth. So if I put $30,000 over the next 15 years and my 30,000 grew to become 60, so the 30,000 that I have growth from will actually be taxable money. And typically we say that if you are going to take that money out, make sure that you have room in your RRSP, in your own registered retirement saving plan, so that when the money comes from RESP, instead of getting it taxed, you just simply fill up your RRSP room and pay no tax at all whatsoever.
Makes sense.
So, okay. Can I hold RRSP, TFSA, and RESP at the same time? 100%. You can own a Toyota and a Honda and a Mercedes at the same time, and you can actually park them on the same driveway. So there's no comparison between the three. All three of them, they come with their limits, though. They're not limitless plans. So RRSP has its own contribution limits, and TFSA has its own, as well as RESP is also restricted by its limit. But you can definitely, and I'd actually say not can, I say definitely you should be contributing to all three of them, depending on your income and your situation and affordability. All right. So is visitor insurance enough, or should I get private health cover as well? So if you are talking about a visitor who's coming to visit you from outside Canada, then in all likelihood, they would not qualify for a private health cover that is provided by the companies that are here. So in all likelihood, you will just be depending on, or just be relying on the travel insurance or the visitor's visa insurance or super visa, whatever status they're on, that insurance only. And in that scenario, that should be enough. We normally recommend that people take adequate cover depending on the age and their medical condition, that this is what they should be buying. So let's say if they buy 100,000, I would say that 100,000 should be enough. And if we need more, we can buy more. But they don't need any private health cover, and there is no requirement for that.
So while you are on visitor insurance, does it only cover emergency services, or you can go walk in to the medical centers as well?
So the walk-in clinic is also counted as an emergency if you call it. It's definitely a smaller emergency. So as an example, if I just had let's say a sore throat for the last 3 days, or I have a chest infection and I need to go see a family doctor, or I need to go see a walk-in clinic, it's perfectly okay because that would just be counted as a minor emergency. And if I need to go to the hospital, then for sure. So all kinds of emergencies, minor or major, are covered. However, what is not covered is that if we have an elderly parent who, let's say, goes and gets their full health checkup done in every 6 months, all blood work and all their full body checkup, that kind of coverage will not be a part of the visitor visa or super visa plan. And in that case, if you do choose to do it, you will have to pay out of pocket to get that kind of work done.
What about dental services?
So dental is also very specific that most companies, I work with 13 of them. I would say pretty much all of them, they will not cover your regular dental checkup or a dental hygiene appointment. So if you do end up doing that, I would say go be friends with a nice dentist and maybe get some discount if you can. But no, you would not be covered. The only things that are covered in dental are most companies, I would say, would cover a dental pain. So if we have like a really bad pain in the night and we have to go to see a dentist, but those covers are typically confined to $300, $200, $500. They're not in thousands, so they're not going to cover something like a root canal. And then there is something called a dental emergency repair. So if that happens, which is that, let's say I fell on the sidewalk and I chipped my tooth and it cost like $1,500 or $2,000 to repair my tooth, that kind of coverage will typically be a part of the coverage, probably between $2,000 to $4,000, depending on the company. All right. Do I still need a medical exam to buy term life insurance in Canada? So medical exams can be of two different types. One is a physical medical exam where a nurse comes to the house and he or she takes blood work and takes a urine sample, takes blood pressure, and takes all the vitals and height and weight and so on. The other type of medical exam could be, which is not physical, but just a questionnaire where you're answering questions based on your health, and they typically are divided into your different systems of the body, so respiratory questions and digestive system questions and so on. So if the underwriters decide that, let's say we applied for $1 million coverage, now up to $2 million typically, it's on the discretion of the underwriter that will they want us to have a full body checkup questionnaire, or are they just going to do questions on the phone? Sometimes they do random audits as well, where they will select a person to do the full questionnaire and checkup, while with some it could be just that. Now, there are some specialized companies who do a non-medical term life insurance, but those ones are typically speaking, they are only good for people where they may have certain medical conditions. So we can have a term life that can be provided without any, so that is called a non-medical issue. And typically non-medical issues are guaranteed issues. So all you need to do is to answer a few questions, and then based on that, they'll issue you the insurance. But those insurances come with a lot of caveats. As an example, they could come with a caveat that we will not cover your death for the first 2 years. So, which means that you're buying the insurance today, you are technically speaking covered today, but you're not covered if you die within the first 2 years. So, non-medical guaranteed issues are not my first choice. They're always my second choice, that if somebody does not get approved in the regular medical way of getting the term life insurance. Are RESP withdrawals taxed when my child goes to school or penalty free? So RESP has three components to it, as I was mentioning in one of the other questions there. So you have your principal that you put in, the grants from the government that came in, and number three is the growth. So there's grant, growth, and principal. So when we take the money out of the RESP, the withdrawal, so the principal is entirely tax free. There's no tax on that because you already put that money in from your pocket after paying taxes. So the government is not going to tax you again on the same principal. The second part is the grant. Grant will be taxable because you never put that money from your own pocket. This was the government money and you received it tax free. So now when you're going to use it, you're going to pay tax on that. And then the growth is also fully taxable, like an income. So let's say if I had $50,000 of a total in my RESP and 25 of that was principal and 15 of that was, or 20 of that was growth and 5 of that was grant, then I am only paying tax on the 25 that was grant and growth, and principal no. But then we also have to take that money out staggered. We're not going to take all the money out in one go. So the idea is that the student who is most likely not working a lot, maybe they just work part-time, make $10,000-$15,000 income over the summer, and now we add another 10 or 15 on the top, they're going to be in a very, very small tax bracket. They might end up paying 10% tax on that money. So it is still pretty tax efficient in that sense. Okay. How flexible are TFSA withdrawals? Can I replace withdrawn contributions soon? Well, that's a leading question because the TFSA withdrawals are very flexible, other than if you had an insurance kind of contract, like a segregated fund contract in which the money is locked in for a certain period of time. So that's something that you should always question with your advisor to make sure that those, if they are locked in and if you're okay with that, that's different. But in many cases, I come across clients where they had no idea that their money has been locked in. So put that aside. The government does not put any restriction on when you can take money out of the TFSA. So it's actually one of the most flexible things that you can do. The only thing you have to be careful about is that whatever money you take out from the TFSA, it only gets replenished on the 1st of January next year. So as an example, let's say I had $100,000 in my TFSA and my room was also $100,000. So my TFSA is full. I took $20,000 out in March or April or May, and I just needed to buy a car. So I took $20,000 out and I made the payment on my car. Now I cannot put the $20,000 back into my TFSA until the 1st of March next year. So next year, 1st of March, I will also have 20,000 plus my new year, 2026, for example, I will have the room for that year. So on the 1st of January, 2026, I could technically speaking put 20,000 plus the 7,000 for the next year. So 27,000 is what I can put in. So TFSA room does get replenished on the 1st of January every year. Is RRSP only useful if I'm earning a very high income? I wouldn't say it's a very simple black and white question, because I would refrain to actually say that it's only useful in this scenario, because it could be many different scenarios. However, you can do the calculation yourself to figure out, say, for example, if you are in a 20% tax bracket and you are only starting out your career, and you believe that in the next 1 to 5 years, you are going to be in 40 or 50% tax bracket, it might make more sense at that point, given obviously the other conditions that I don't know. So it might make more sense for you to withhold and not actually let your RRSP room go to waste or go to use for only 20% tax back. And if you keep that room, let it roll over, and then in 5 years' time, when you are making so much money that you are in a 50% tax bracket, you might want to use it then. However, again, everybody's situation is different. Maybe the 20% today is more useful to you compared to the 50% in 5 years from now. So I don't know. The other question is that if you have a lot of real estate or other instruments which you are going to sell and suddenly trigger a lot of taxes, you may want to use your discretion in when do you want to use your RSP the most effectively. So it's not just about income; it's also about a myriad of all the other things that you may have associated with your income and your lifestyle and so on. So yeah, unfortunately, it's not a straightforward answer. Number 12. Is buying life insurance after 40 pointless because premiums are too high? Very interesting question. I could say the same thing. Is life insurance useless after 50 or after 60? My question is life useless after 40? No, it's not. Life only starts at 40 these days. So life insurance is not pointless. Yes, you pay a little bit high premium, and every year as your life becomes older, you will be paying more and more premium. So it's always good to lock in your at least your term insurance. I always say term insurance, your critical illness. It's always good to lock them in as early as possible. However, if you feel that you're late, trust me, you're not. We deal with clients sometimes even in their 60s, even in their 70s. So there are always different uses and different use cases for having a term or a permanent or a critical illness or a disability insurances in your life, and it's never pointless. And that will totally depend on your situation. But yes, at 40, you may still have young children. You still may have a lot of debt to pay, and you may still not have a lot of savings. So I would say it's still very, very useful and helpful to have it. What qualifications or licenses do you need to become a financial advisor in Ontario? So, financial advisor now as a title is actually protected in Ontario by law. So, unfortunately, or I should say, fortunately, people cannot just simply call themselves as financial advisors anymore. They have to be qualified. So, at some point, we used to have that somebody who is just advising people on money, they could say, I'm a financial advisor. Lately, a lot of people who were just insurance advisors or insurance agents, life and health, they would actually write in their title as the word financial advisor, no more. And if you are one of those guys who are listening to me, then please read the legislation and stop using the title, because this could completely jeopardize your rest of the career that you have. So the qualifications that you have is, for example, you have to be a licensed investment fund advisor, or you have to have a certification, which is the CSC or the Canadian Securities course, or you may be doing an MFDA, the Mutual Fund Dealer Association course. You could also be a certified financial planner, CFP. And then if you go on the website for Financial Services Regulatory Authority, they do have a list of all the different things that you could have. You could be a PFA, a personal financial advisor, and you could write that. So if you look at the list, it's a pretty vast list of, there's at least 15 or 20 different qualifications that you can have in order to call yourself as a financial advisor, but definitely not life and health insurance person cannot call themselves as the advisor. So stop doing that if you're doing this right now. Do advisors earn more from selling insurance or investment products? Okay. It depends again, because when it comes to insurance is typically only a very much of a commission based or a direct remuneration based product. So as people are selling insurance, they are getting paid for what insurance have they sold. On the investment side, though, the models can be very different. You can have an advisor who gets paid for placing an investment product for you. You could also have a very much like a fee-only advisor, where I could say that, okay, if you come and get advice from me, I will charge you X amount of dollars, but I will not sell you any investment products. Which model is better for you is something that you completely decide. In the bank, for example, when you're paying, your fee is weaved into your actual investment product itself. So you don't directly pay that out of your own investment, but it actually comes out of the product itself. So yes, so there can be different models. And when you say, do you get paid more? So insurance is a one-time payment predominantly. There can be a very small service fee that gets paid in the next subsequent years, but that's very, very small. And remember that when people are putting money into insurance, if somebody has $1 million to invest, they are not buying $1 million of premium of insurance. So let's say, if an example, they spent $5,000 a year on their life and health insurance, then it's also a very, very small ticket item compared to the $1 million that they have just given you to invest as an advisor. So they do balance out in that sense, but in absolute numbers, $5,000 of life insurance premium sold versus $5,000 of you putting that money into an investment pays a lot less. So yes, but you'll never buy the two of them at the same level, for sure. Be honest. Ha, that is funny. Have you ever sold insurance to a family member just to hit your monthly target? The funny thing is that, I mean, my answer is an emphatic no, but the funny thing is that I do not have any monthly targets. I don't even work with those targets. I have zero targets. I have nobody to answer to that actually tells me that, hey, you have these targets. I do not put any of these targets or so-called targets on any boards or visuals or even invisible boards or in my head, because as soon as you start working on insurance, on investment, or any of these things, as soon as you start working on these in numbers, you start putting the client behind, because now client actually becomes a number for you to say, oh, I need to achieve XYZ from here. And in, that's a totally different philosophy. And, good luck to them who work with that philosophy. But from my perspective, if you are working on those monthly targets and then you are trying to forcefully meet those targets, you're basically, I would say, you're in the wrong profession. You should not even be here, because in this profession, the sanctity of this profession is the client being the center of it, and what the client needs is what you have to design. If you start designing it the other way around, that I'm going to design it based on my monthly target, now the client is out and you are at the center of that universe. And to me, that's a big no-no, and that's what bring disrepute to the industry as well. So get out of here if you're doing that. Unfortunately, that's all I can say. How many friends stopped picking your calls after you became a financial advisor? I haven't called a single friend for financial advice or a product. In fact, I don't do any. I don't do any calls. I think that's a very old style way of pushy sales things. I think people should see the value in what you provide. And once they start seeing the value, then they will pick up the phone and call me. And I would say I have lost zero friends by being a financial advisor. If anything, I've actually gained a lot of you, and some of you who are watching here, like, how proud I am to build those relationships with you and to actually call many of you as my friends, and many of you who are now parts of my inner circle friends, and many of you are still a part of my friend circle, and we see each other. And then many of you who might just be watching and we have never ever met in person, but we've been doing business together. Nothing changes. Like, whichever level of friendship are we at, it doesn't change anything for me. Even if you're my best friend, I still keep the same level of confidentiality. I still keep the same level of trust and transparency with you, versus even if this is a complete stranger who just calls out of nowhere and says like, "Hey, I need advice." My treatment is exactly the same. Even my fee structure is always going to be the same. My treatment of anybody is always going to be the same. So very, very fortunate that nobody has stopped picking my calls because I don't call for work. I only call if I want to talk to you or we have something. And most of the times it's the other way around. I think I have probably not picked up many calls after becoming financial advisor because sometimes it gets busy. And but if you are one of them that I've not returned your call, then I'm sorry. But most of the times I do come back and return your calls.